All right, we're live. My name is Amar, and I'm from Client First Capital, and this is my good friend.
Kyle, I'm with Clover Hill CPA.
And today we're going to actually change gears here. We're going to start doing like a frequently asked questions. So I run a financial practice. Kyle runs a CPA practice, and sometimes we tend to get similar questions over and over again. And so we're going to try to answer some of those in a video format. But before we get started, let me share our lovely disclosures. Basically, it says we haven't taken your accounts or your situation into account. We haven't started a formal relationship with Kyle or myself. And this is for educational purposes, right? So we haven't, Kyle, would you say with the broad brush we covered that?
I think we got it. Yeah.
All right, good. So the questions we've been getting. So the first couple questions are around inheritance, specifically inheritance of an IRA. And then the second set of questions that we've been getting is around gifting, especially this time of year. How do I gift? How do I gift to my children, family, family members, etc.? What's the most beneficial way? So this is going to be a discussion. So Kyle and I will go back and forth, right? But because of the Secure Act with inheriting IRAs, for example, there is certain rules that you have to abide by, right? So if it's a spousal beneficiary, then they can make it their own IRA and then continue the RMD table. But if it's a non-spousal beneficiary and it's going to, let's say, your children, they have a 10-year window to take those distributions. And so the question that I got was, what if my child dies within that 10-year time period? And so, Kyle, should we go over this question? I think we talked about it. Well, let's talk about it in two ways. One, if you have an inherited IRA before the Secure Act, what happens, right? And after the Secure Act, what happens?
Yeah, and so the Secure Act was passed, I believe, it was 2018 or 2019, and went into effect in 2020. And so if you have an IRA that you inherited before Jan 1, 2020, you can take the RMDs based off of your lifespan schedule, meaning that you kind of get to reset it. Let's say your parents passed away when in their 80s and you're in your late 50s, early 60s. You still have a little bit of runway before you hit the RMD age and the required distribution payout schedule, because as you get older, you're required to take more and more of your RMD out based on your projected lifespan. Now with the CARES Act, that changed, and you're required to take the RMDs based off of the person you inherited it from. So your parents' RMD schedule continues for a non-spousal beneficiary.
Yeah, and so if it's a non-spousal, you actually have, and you died before 2019, December 31st, 2019, the RMDs are going to be using actually your age on the single life expectancy table. And if you go into the irs.gov website and you put single life expectancy table, you will find that it's I wouldn't call it maybe a more aggressive withdrawal rate than what a standard RMD table is. And let's say mom and dad passed, mom and dad, either one passed away. You inherited this IRA. Your siblings inherited this IRA. One of your siblings passes away, and then your children receive it. Well, in that case, just exactly what Kyle said. It's based off of your generation 2's age in that single life expectancy table, regardless if it's left in a trust or what have you there, or outright distribution. Now let's fast forward. If you pass away after January 1st, 2020, and this is with the Secure Act, right? So now you have a 10-year distribution rule. I guess the question here is, if you pass away and it goes to a minor, the minor has RMDs up until age 18, and then they have a 10-year rule. And then if it's going to somebody that's not a minor, they have 10 years. Is that right, Kyle?
Yeah, that sounds correct to me. Yeah.
Yeah. Now there is some exclusions out there. If you're like chronically disabled, or if there are a couple things there. So just double check the nuances that may apply to your specific situation. So that was our first question, right? Like, how do I deal with inherited IRA and the person I'm giving it to, 5 years, whatever, and if they pass away, how does that go through the family? The second question that we've been getting here, Kyle, is about gifting, right? So if you're gifting to children, let's just say, the annual exclusion amount is
15,000.
Yeah, 15,000 per spouse. So technically, you could give 30,000 to each child, right? You could give
Yep. And one married couple can give actually 60,000 to another married couple. So you and your spouse can give 15,000 each to let's say your son, and then 15,000 each to the spouse, for example. So actually, yeah, one married couple can give 60,000. One single person can give 30,000 to a married couple, or you can give 15,000 to each individual.
Yeah. And if they have children, you could potentially do more, right? Because you could also do that to the children as well, right? So if you think about it, it's just a factor of 30,000 per person if you're married, 15,000 if you're single, right?
Yep. And so, yeah, 15,000, that's all cumulative gifts. So let's say your kids rent, pay you rent or something for your house at a below market value, and then you write them a $15,000 check at Christmas time. Well, technically, you've gone above the $15,000 limit because the reduced rent is actually considered a gift. So you kind of have to look at it holistically. It's not just cash amounts gifted to your kids. It's really what kind of financial benefit do they gain from you on an annual basis.
Yeah. So that's good. So that's if you're gifting cash. What if you're gifting, let's say, shares of Apple, Microsoft, name it, whatever stock that's out there? We're not giving a recommendation to gift those, just to be clear. Just gifting any stock, right? How is that treated for the children? So, Kyle, you want to answer that one?
Yeah, let's say you bought Amazon at $200 and now it's at $3,500, and you've had a really huge appreciation on it. If you were going to gift that stock to your kids, the gift is considered the fair market value of the stock. So the price, 3,500 times the number of shares, and your basis actually carries over to your kids. So you don't avoid any capital gains, or you don't mitigate any of that income tax liability by gifting your kids. But what you do is pass it on for estate purposes. So kind of the name of the game in gifting, if you're kind of more in the high net worth brackets, or high net worth individuals, is try and gift something that's a little, that's going to be a lot in the future, right? Because the growth will go outside of your estate, and you don't have this accumulating estate tax liability as you get into your 60s and 70s. And when you get to that, the earlier you plan for that, the better, right?
Yeah.
So gives you more options.
This is a game of moving chess pieces from your balance sheet to your children's balance sheet, right? And
typically, that's a good way to put it.
You want to make these pieces that have the most amount of growth potential on your children's balance sheet. So, if one reason that we see, some clients doing this to maybe grandchildren that are graduating college, they're doing it on their own tax return. They're maybe at a lower income bracket than the grandparents may be. So for you to sell stock, you may have to pay, 23.8% in capital gains, plus your state, whatever there may be. But for your grandchildren or your children that are maybe in a lower tax bracket, it may be more tax advantageous, right? So there's some considerations there. And then I guess the third thing that we should probably cover, Kyle, is that there are people out there that have irrevocable trusts, right, for their children. They've set up a trust for their child, and then figuring out, how do I fund that trust, right? And so if you put something with a low cost basis in there and it gets sold, there's a capital gain. And that gain is taxed in the trust tax return, right? And so if that trust is, let's say, pays your children 5% a year or whatever and has that income stream, your children are only going to be gaining a K1 for the taxable interest and dividends, not the capital gains. The capital gains will be kept in the trust, right? So sometimes when you're gifting into a trust, it may be better for mom and dad to pay the taxes, sell something, pay the taxes, and then gift that cash asset into the trust.
Yeah, so very rarely are irrevocable trusts an income tax planning tool. Really, it's more of an estate tax planning tool in my experience. And just for the same concept we just mentioned, that you want the growth to be outside of your estate, this kind of formalizes everything and separates it and makes it a lot more divisible, at the time you pass. And yeah, I think being very conscious of how you're funding those trusts and with what assets. Typically right now, appreciated stock may or may not be a good, funding source. I'd say probably not, because if you're gifting something that's greatly appreciated outside of your estate, you don't get the step up in basis at date of death. And so, that's a huge planning tool, is, making sure that you have greatly appreciated either assets, whether it's real estate or securities in your estate, at date of death, to get that step up in basis.
Big step up. It's huge.
Yeah. And so, I've had a couple of folks where their parents bought their house in 1965 for $35,000, and now it's worth, $1.5 million in the Seattle area. And you get all of that appreciation is tax free if it stays within your state. Now you have a state tax to consider on top of that, so it's not all gumdrops and roses there, but
so we should probably do another video on something like that with appreciated real estate, maybe even rental real estate, where now you're able to write off, the cost basis has gone up, so now you're going to re-depreciate that schedule. But I think this is great. So just to summarize, inherited IRA, there are rules. If the person that's inheriting it passes away, that it would work by, depending on the original owner's death in terms of date wise. For gifting, there's 3 ways. There's cash, right? So 15,000 per person, or 30,000 for a married couple. There's you gifting securities, and then there's gifting into a trust. So if you have any questions or if you have any comments, please leave it below. If you want, if you have any ideas for Kyle and I to kind of answer some things that you're thinking about, just also reach out to us. And this will be our last video for the year, and we'll see you in 2022. Anything else, Kyle?
Yeah, we've had a good 2021 video series, so happy to close out the year here. We thought gifting was topical, just with Christmas coming up and holidays. So thank you again for watching. Hope everyone has a great holiday season, and we'll see you guys in the new year. Appreciate it.
Sounds good. Bye.
Bye-bye. Bye-bye.